Great pleasure to always bring on board Prashant Jain to talk about markets, economy, life, investing, and what his learnings from the COVID crisis has been. Prashant, fantastic to have you back on ET Now. Prashant, there are lots of moving parts. Medical crisis, economic crisis, central banks are printing money, contraction is happening in earnings. I'm sure by now you must have put everything together, what it means for the companies and what it means for the stock markets. So why don't you share the big picture with us first, and then I'll get into specifics.
So Nikunj, good morning and good morning to all your viewers, and I hope everyone is safe. I think these are clearly unprecedented times, but yes, you are right in a way that given the several weeks that we have had to digest this, I think there is some more clarity in views. I think the current year will be an outlier year, and it will be an extremely difficult year for the economy because for 2 months almost half the economy is not functioning, and that will lead to a significant economic impact. And analysts now estimate between 5 to 10% GDP contraction in the current year. And I think very top-down, very broadly, those numbers appear to be realistic. It will have a significant fiscal impact as well because there will be severe loss of revenues. I think corporate profitability will also be hit sharply, especially in sectors where the fixed costs component is higher and where the discretionary element of sales is also high. The good news is that the external side of India looks to be very strong, and India is very uniquely placed amongst the emerging markets. Unlike most of them, we are a large oil importer, and our exports or the merchandise exports are less in a relative sense. I think on a net basis, the fiscal deficit we think will go up 2 to 3%. And the balance of payments, I think India could look at a year of trade surplus in the current year after almost 10-12 years. I think, therefore, currency should remain stable. I think interest rates could move lower. In net, I think it would be best to skip this year whenever we are thinking anything about the economy or the markets. I think we can look at fiscal 20 or we could look at fiscal 22. And why I'm saying that is, see, last year, let's say the economy was 100. And current year, just for the sake of argument, let us assume it is 90. Most of this degrowth is because for 2 months, which is the economy did not, it functioned at only half the capacity. So the impact of that itself is 8%, because 2 months divided by 12 is roughly 16%. And half of 16 is 8%. So bulk of the degrowth in the current year is being contributed because of half the economy not functioning for 2 months. Next year will be a normal year. Therefore, on this low base of 100 becoming 90, we will go back to 100 automatically to my mind because of 12 normal months. So next year, optically, the growth will look to be in double digits. And neither this year is a representative year of long-term economic growth of India, and nor will be the next year. So I would say current year we should ignore in our calculations, in our estimates, and we should just focus on next year and ignore the growth of next year as well. But from a valuations perspective, market perspective, macroeconomic perspective, I think next year is a more normal year, and after that, of course, life should come back to normalcy. Yes.
Okay. My next and immediate question, Prashant, is that how does one go about predicting and talking about future when the future is uncertain? How can one risk capital or position capital for future returns where we know that 6, 12, 18 months are going to be unpredictable, impossible to fathom, and hard to comprehend?
Nikunj, by and large, agree with you that future is always hard to forecast. And even Einstein said that I don't worry about the future; it comes soon enough. So I am not claiming to be able to forecast the future accurately, but I think to base your judgments on the current environment, also to my mind, would be a mistake. Because let us not forget that the real economic impact is because of the lockdown, because of the shutdown. And once shutdown is lifted, once lockdown is lifted, and we are in the process of doing that, you will see by and large, at least in terms of the economy functioning, life will come back to near normal pretty quickly. I mean, people may still not step out of their homes unless it is essential. Only half the people may come to offices, balance may work out of home. But at least in terms of economic activity, demand conditions, I think life will limp back to normal quite rapidly. And all I am saying about the future is that life goes back to normal, which I don't think is such a big assumption. If you go back and visit events like 9/11, Lehman, Asian crisis, Pokhran, tapering, I mean, we have heard similar sentiments around like what we are hearing now. So I think it would be wrong to extrapolate the current economic conditions into the future. There is a strong tendency in businesses and in life for mean reversion. And I think sitting at one extreme, we should not extrapolate extreme situations. And all I'm saying, and I feel reasonably confident, that life will come back to near normal pretty quickly.
Mastered the art of understanding market cycles, and you've done very well. You've made a career trying to understand market cycles, and the word mean revision, which you said, I'll amplify it for our viewers. It essentially means that nothing goes one way up and nothing goes one way down. So where are we in terms of market cycle? Because the market can be divided into two: non-financials and financials. And frankly, the non-financial part has not done bad. It's only the financial part of the leverage play which is completely on the butcher block.
So you are right, Nikunj, and I think as you are aware, the last few years, the consumption growth in India was supported by uh, uh, fast-growing retail loans. And last few years, we also saw higher corporate slippages, very high corporate slippages. And in a way, it is both fortunate and unfortunate, depends on which way you look at it, that just when the corporate NPAs were coming to an end and one was hoping that the financials will report near normal earnings, we are hit with this. And I think what is happening now, it hits at the very root of the retail loans, not the mortgage loans, not so much the passenger loans, but I think the smaller retail loans, I think, will get impacted in two or three ways. One, I think when corporate profits come under pressure, the wages will come under pressure, whether we like it or not, because companies need to endeavor to maintain profitability. And at times like these, companies tend to take a very hard look at the costs. So I think wages are coming under pressure, which will inhibit the ability of or willingness of people to take on loans also. So there will be a strong tendency to cut down on anything that is discretionary. I think post the Yes Bank restructuring and post the challenges that the bond markets in India are facing because of what has happened in the mutual fund space and consequently what is happening in the bond markets as well, I think the ability of the small banks, the NBFCs who were mainly focused on extending these small retail loans, I think both the capability and willingness will change. So I think, and simultaneously, I think what we'll also see is because of the moratorium, time will tell what are the slippages. But I think in this cycle, we will see what was happening to corporate loans will probably happen, I hope not in that degree, to the retail loans, at least in certain pockets. And I think that is what the markets are reflecting, that when retail loans don't grow, fee income suffers, balance sheet growth suffers, there are provisioning costs to be made. So I think you are right. And in a way, it is fortunate because had both these happened simultaneously, it would have been even a far greater challenging situation. And that's why I said, in a way, it is okay because it is a better situation to be in, because once the corporate pain is out, that is when you are faced with this once in a lifetime kind of situation.
But Prashant, the corporate banks which you own and they are part of the declared portfolio, I'm not guiding the conversation towards stocks here, but just a general theme here. Let's say in SBI and ICICI Bank, they do have a large retail book. So while the corporate book may not take a scary dip because government has decided to roll out a guarantee, there is liquidity, a lot of deleveraging already happened before the crisis. But if retail delinquency starts, ICICI Bank will also suffer, and SBI will also suffer, and HDFC Bank will also suffer.
See, Nikunj, you are right. I think that there will be pain, but I think the pain will not be evenly spread across the various entities. While retail loan composition itself is quite low for some of these banks, and for some of these banks, the retail loan composition is high, the underlying loan composition and the customer segmentation, the customer profile is quite different. And banks that have focused on mortgages, banks that have focused on salaried customers, mainly either in large corporates or in the government sector, or even if you have extended automobile loans or unsecured loans, but if your customer profile is better, I think the impact would be far less. So I don't think you can simply say that X retail loans across entities will behave similarly. I think the next 6 months, 12 months will be very interesting. And I think we will get to discuss this with greater detail when we have more data after, I think, 6 to 9 months. Yes.
I've got one more follow-up questions on financials. Most of the mutual funds currently are overweight financials, and that's largely because of benchmarks and largely because of the positioning. Do you think somewhere it's the positioning which is also hurting financial stocks? Because when you have redemption, you sell what you own, and both local and global investors, especially mutual fund investors, they own a lot of banks and a lot of financials.
I think you are right, and not just local funds. I won't say all funds are overweight, but yes, they are somewhere. Someone is slightly overweight, someone is neutral, someone is slightly underweight. But since the financials are such a large weight in the benchmark, it's a fair comment that most institutions, mutual funds, I'm sure other institutions also have fairly significant positions in this space. And what is true for local investors is probably even more true for the foreigners. Because if you look at their positioning, I think it is even bigger overweights, far bigger overweights in that space. And that is probably what we are seeing. And I guess from the prices that there is considerable amount of selling in that space, mainly from the foreigners. Because please remember that the last 6 to 8 weeks, I have seen the highest ever FII selling intensity. And if half of your portfolios or 40% or 30% for some was in this space, it is hard to conceive that that space would not have seen selling. So I am sure that but the selling is driven by the worry around the evolving situation around NPAs and driven by moratorium, shutdown, loss in wages, etc. So I think both growth and the asset quality is the issue here, and that is why we are seeing this outcome. But just to think slightly longer, whatever I said, whatever you said is by and large known to everyone, and these are very top-down views. The key again, as I said, is to think, ignore the current year, look at it as a gap year. And the moment you start focusing on fiscal 22 or 23, I think at least our judgment becomes better as to what are we getting and what are we paying. Today, the situation is such that after this significant correction in the financial space, some of the largest banks in the country are trading near one-time book, and the public sector large banks are trading at a fraction of book value. And you can build in reasonable amounts of stress, but as long as you agree that this what is happening today is temporary, and I don't want to extrapolate that into the future, then when you are buying a large comparative business around book, below book, I think chances of going wrong are quite low. And let us not forget, Nikunj, that this environment is actually very supportive of the large banks. See, I think what this has done, the events of the last few quarters, they have highlighted the importance of the liability franchise, both for banks and for NBFCs, which markets have long ignored. So I think the banks with strong liability franchise will come out stronger in this environment because they will gain share, one from smaller banks, two from NBFCs, and three from the bond markets also. And let us not forget that one more transformation what is taking place in the retail loan space. The large banks were either not in a position to or not doing small retail loans across the board. Some of them were doing. But now with the rapid migration towards digital loans, the enhancement of digital capabilities of the banks, the vast progress that we are making in making use of the data which these banks have, I think they will compete very effectively in the very small loan segment also. So I think the large banks, the tech-savvy banks, the banks which have good liability franchise actually will come out very strong with higher market shares even in the retail segments.
Prashant, you are a classic value investor, which is that you like to buy stocks cheap, businesses below the intrinsic value, hold on to them, you value them based on dividend yield, debt and future growth. And that explains why you have an NTPC or an ITC or HPCL and other oil marketing stocks in your portfolio. But some would argue that in the post-COVID crisis, given that how NASDAQ has moved up, how a stock like Nestle or Britannia has made a comeback, are you getting challenged on your thesis of buying cheap and value investing? Because in this new normal, will the classic old way of value investing, buy cheap and sit tight, will it work?
So Nikunj, you are right. I mean, I do have a value bias, and you could say I have been on few occasions earlier than what one would have liked to be, at least with the benefit of hindsight. And this cycle of pain for this approach of investing has been longer than what the pain one has experienced on similar occasions in the past, way back, whether in 2000 or around 2007. But see, what is value investing? I mean, while we like to put words around, I think value investing is simply saying that I want to buy a business that is strong, that is well managed, at a price which I believe is lower than the fair value. The discovery of fair value at times is a function of the environment and the market. And you are right, this time around, value investing has struggled for longer than what one had anticipated. Initially, it was driven by the extension of the elongation of the corporate NPA cycle, the delay in resolutions in the IBC. And when we made good progress around that, we are hit with this. So I think this is one of the risks which investing in general faces. But let us also see, look at the what has happened to many NBFCs and many small banks. They've lost 70-80% value. And I think in many cases, not in all cases, the permanent damage to those values is more than in the large banks, which I think will come back pretty strong. So I think it is returns delayed, not returns denied. And clearly, this tests the patience of our investors or people like me. And this is one of the difficulties in investing, especially in benchmark kind of situations. Now, let us go back 10 or 12 years. And it's a long time. Most people don't think such long in investing. But go back 10 years. What was the hot sectors and what were the most preferred or the least preferred sectors? Utilities 10, 12 years back was the most preferred sector. And surprisingly, it was the FMCG and the pharmaceuticals which were the least preferred sectors. You can go back and play our tapes of 11 years back. So people willingly, happily bought these utilities at 2 times, 3 times price to book, and they did not want to participate in the FMCG and the pharmaceutical companies in low double digit or high double digit kind of multiples. And that is when at least my funds did the opposite. We bypassed the whole infra boom and the pain, subsequent pain, and we were significantly overweight consumer, FMC, pharma, etc. It caused a lot of pain in 2007, but the next few years were extremely, extremely strong. I think today what is happening is you have a very just the opposite situation. So we have seen these FMCG companies go up from 12 to 20 Ps to all the way up to 70, 80 Ps. And on the other hand, the utilities have steadily moved down from 2 times, 3 times price to book to below book. And the dividend yields on the utilities space are now, in many cases, 1 time bond yields, and in few cases 2 times, and in some cases possibly 2.5 to 3 times also the dividend yields. So let us not forget that the environment that what we are facing, one, it is of low interest rates. And I think this is one thing which both the government and the RBI, they will keep on trying to push interest rates lower, because it will make life easier for the borrowers, for the companies, for consumption, for the government itself. And I think when interest rates move that low, it is supportive of high dividend yield stocks. And these dividend yields are growing. So, I mean, if you look at the per capita power consumption in India, it is a fraction of the world. So I think power in India represents a growing business, and it is not a typical utility that they will not grow. And if you look at the growth rates of these companies in the past and in the future, I think they are quite respectable. On the other hand, I feel the impact on wages, on livelihoods. See, what we did not discuss so far. See, what is the real impact of this? One is, of course, corporate profits in stock markets. But the bigger issue, I think, here is that the share of the bottom half of Indian households, the lower 50% households in India, have a 15% share of the GDP. That's it. So what that means is the monthly income of these people, of these families, the bottom 50% families, the average is 25,000 rupees a month. Now, just imagine what is happening to the retail, to construction, to service sectors, to SMEs, MSMEs. So I think there will be significant social impact. Incomes will be disrupted in the most vulnerable sections of the society. And unfortunately, over the last 2 decades, because of the easy availability of small ticket retail loans, and because of the propensity to consume, and which we have all experienced, I think the savings with the lower income groups is much low compared to what they used to be 10 or 20 years back. So I think because of the real impact on incomes, because of the fear of the uncertain environment, and also because you may have EMIs to service, I think there will be a sharp cutback on consumption. And I think, and some people feel that FMCG is just basic, it is not discretionary at all. I don't think that is entirely true. To spend few hundred rupees on a expensive chocolate or a biscuit or a juice or shampoo or deo or a skin whitening cream, I mean, these may not be discretionary for the middle and the higher income groups. But please remember, these are mass market products. There are tens of crores of customers consuming this, and the incomes of many of them are going to be impacted. So I think these products become discretionary for those income groups, especially at times around these. So my view is, and let us see how things play out. I am also very keenly watching this. I think the growth in this space will be disappointing to what the expectations are compared to. And I think it does not justify the very rich multiples that this sector is trading. But I would again like to revisit this with you after 6 or 9 months, because by then, I think we will have greater clarity on this issue.
Okay. You bought into autos in 2009-10. You sold out of autos between 17, 18 and 19. Auto stocks have fallen. Are you tempted to buy this discretionary end of the market? Because if your view on the economy is not very dim, and the fact that auto companies have, at least the big ones, don't have a debt issue with the exception of Tata Motors, does it make sense to be a contra buyer in autos?
See, I think that space, one, if you see the last few years, the growth itself was in single digits. If you look at the two-wheeler sales growth or the four-wheeler sales growth, in the best of economic conditions, the growth was in single digits. And I think for some of these companies, a fair part of the earnings are also coming from other income. In fact, in some cases, it could be as much as 30-40%. As you rightly said, they have cash on the balance sheets. So I think 2 or 3 things will happen now, to my mind. I think this sector will feel the maximum pain in the current year. One, as you got into the current year itself, the sales were weak for last few years and quarters especially, number one. Number two, this is a high fixed cost business, and at least in pockets. And I am clubbing the auto ancillaries also in this space. So I think when volumes drop 20, 30, 40%, and I don't think anyone has a clear sense on how much volumes will drop, but drop they will, and drop they will quite sharply. The other income component, while it is very good for the balance sheet, and these balance sheets are not at risk, at least the larger companies, I think what will also happen is while you were earning 8-9% return on that cash, it is likely to fall to 4%. So I think the other income component will also take a hit. And if you build in these kind of numbers, and even if you build in reasonable recovery, let's assume next year life goes back to where it was in fiscal 20. I think even then, to my mind, the valuations are reasonable. They are not screaming buys. But I think the risks are considerable, because it is a very big assumption that the volume comes back to where we were last year. Because as I said, please understand, the impact on wages is real. And I don't think once companies get used to lower costs, that they will let go of those costs. And when I speak with companies, I think the impact on wages is significant. And the auto, at the end of the day, is a discretionary product. There will be a very small section of people who can afford to buy an automobile, a two-wheeler or four-wheeler, but who do not have one. And because of the need to keep a social distance, that demand may be there. Next few months, there could also be, because last few months, those who were contemplating to buy have not been able to buy. So next few months, I think we could see a surge in sales also. Current indications are not that, but it is possible. But I would like to wait for some more time before I think I can take a view on the likely revival in automobile sales.
Interesting portfolio change I can see is aviation. You've gone and bought aviation stocks when there is genuine fear of these companies going belly up, and fear of flying. Now that's a social change. I mean, business travel will be affected, tourism will be affected. Even if things normalize in India, the way air transport as industry was moving versus the way it will move now will certainly change. Social habits I'm talking about. So what prompted you to look at a beaten down sector like aviation?
Because I would request you to let's make it the last sector question, because this way there are so many sectors and we'll consume a lot of your time and time of the viewers also. But let me share with you some thoughts. See, the cost structures of airlines is reasonably variable, and you can variabilize it even more. So, I mean, how do you fly a plane? You take it on lease. You have crew and you have fuel. If air traffic is less, I can cut the number of flights or the number of planes. So I think the cost structures are reasonably variable. Number one. I think the penetration of air travel in India is probably, I mean, it is one of the lowest in the top 10, 20 economies anywhere in the world. And you will be surprised to know what percentage of Indians fly even once a year. So I think it's a very long-term growth sector. 3, fuel prices are down, which means there are reasonable cost savings. 1/3 of the cost of an airline are in fuel. And you know what kind of savings are there. So it could make air travel a little cheaper. But clearly, see, as I said, let's not look at the current year. And the way to think of this is, if you think 2 years out, do you think life will come back to normal? Do you think air traffic will come back to at least 80 or 90% of where it was 1 year back? Do you think these companies will survive? And do you think, I mean, the pain is there for all the companies. So you try and buy companies which are stronger, which you think will survive. Because at times like these, let us remember, if a business is making 100 crores profit for last 10 years, and you are paying 2,000 crores, 20p for that business. Current year, let's say that business makes a loss, and you believe that business will come back into profits 2 years down the line, maybe not at 100 crores, but at 80 crores profit. And let's say the market value has fallen from 2,000 crores to 1,000 crores. Now, do you think there is value in such situations from a longer term perspective? So I think that is how I would like to reason around this sector. And finally, see, please also appreciate that people like me, we are putting 1-2% to 10, 20, 30% behind a theme, behind a sector. So I am aware of the risks, what you highlighted in this sector. And that reflects in a very small exposure that we have to this space. But I think this is a need which is not going away. Need to travel, the frequency of travel might reduce for business travelers, but bulk of the traffic in India was not business travel. It was basically small businessmen, tourism, visiting relatives, friends, holidaying. I would guess maybe 70-80% of the business is of that nature. And once life comes back to normal, I'm sure bulk of that activity will come back. And let us not forget one final thing, that the affordability in air travel has gone up significantly. When I started work around early 90s, a Mumbai-Delhi ticket used to cost, if my memory serves me right, around 4,000-5,000 rupees. I could be wrong there, but I think roughly it was there. And today the prices are roughly the same. So 30 years and flattish prices, it is something like the telecom sector. So I think air travel is one of the lowest penetrated discretionary products with a necessity tinge, and it is also increasingly becoming more affordable.
So final question, Prashant, the entry point for an investor always determines the future rate of return. For someone who, let's say, wants to start now, looking at valuations, the risk-free return, where the interest rates and liquidity is moving, next 3 to 5 years or next 5 to 7 years, will it be hard to imagine that we are in for are we in for double-digit returns, or are we in for single-digit returns from equities?
Nikunj, this is a very good question and a very pertinent one also. So I think India's market cap to GDP is now around 50% market cap to GDP if you think slightly ahead. Whenever in the history of Indian capital markets cap to GDP have been below 60%, the next 3-5 year returns have been very healthy. It is surprising to see how good those returns are. And we are in one such situation. It is the first year where Indian economy will degrow in 40 years. But I don't think this is the normal going forward. As I said, most of the lost growth in this year will be recouped in the next year. And next year we can possibly look at a double-digit GDP growth also, because it is simply the maths of 50% economy not functioning for 2 months this year and it is functioning next year. So I think very soon in the next few weeks or months, the headlines will change. And I think COVID will move to maybe to the second page, and then over time people will forget. The way it has happened to similar incidents not similar, but of this similar magnitude, I would say, in the past. So you rightly said that and I've seen this, the highest correlation to long-term returns is to the valuations that one pays around the entry time. It is also true that now if you look at last 5 years, 10 years returns, they are very low. And when I talk to people and they feel very disappointed, they are on the verge of questioning the long-term potential of equities. But I think it is precisely when the long-term returns are in single digits, and that is what is reflecting in the low market cap to GDP. I think these are probably the best times to invest in equities. And people can say that, look, I said this, or many others like me said the same thing 3 years back, 5 years back. But we must also appreciate that a situation like COVID, no one in his wildest dreams could have imagined a situation like this. And so I don't think this low returns of the last 5-10 years, which are a result of the current very weak market sentiment because of COVID, I don't think it should lead us to lose faith in equities. On the contrary, if you go back and see in 2001 and 2, we were in a very similar situation. That was a time when 10-year returns of the Sensex were negative. And when I used to go and meet people and they would say, look, you are telling us to invest in equities because you work in this industry, but look at last 10 years. If I had put money in a fixed income instrument, it would have given me more. So I think the observation is same, but the way you read this situation can be completely different. So one view is that last 10 years weak returns outlook is poor, you simply extrapolate. I think the current way to look at the situation is that last 10 years returns have been extremely weak. As we got into this market, pre-COVID, markets were in any case attractively valued, and we have fallen even further. So I think the next few years, I would say, I would look towards them with a very strong sense of optimism, and I would like to look at a lot of opportunity in these very adverse times when large, liquid, strong businesses are available to you at book value, below book value, at dividend yields, which will grow and which are more than bond yields. I don't see how we can go wrong under most circumstances.
That's a fabulous way in which you managed to break it for our viewers. And I'll take that last part once again, that last 10-year returns have not been great. Future returns could be better. Valuations are on your side. Be patient. Learn to digest volatility. Equities for long-term investors. And when we will look back into history, the COVID crisis will be a footnote when you did not panic, and if you participated, it did not cancel your SIPs. I'll say it again on behalf of Prashant Jain. Please don't change your asset allocation. Don't cancel your SIPs. And that's what the broad message. So Prashant, you agree with me. Don't cancel your SIPs. 30-second answer, then we'll take a break.
Nikul, this is the time to double your ships. Thank you.
All right, so I appreciate your time. Thank you very much. Stay safe, and certainly hope to see much more of you going forward. That's Prashant Jain. One guest I always look forward to interacting and learning from. Let's take a break. Markets, they're not in a tizzy, but yeah, things are not looking great also.